You have $1,000 to invest. Metro Coffee made $100 million in profit, while the Daily Brew made just $10 million. Which one should you choose to invest into? Most people will pick Metro Coffee, but that could be a huge mistake. There is one financial number that can help you compare the profits of each company and which one is better investment. By the end of the video, you'll know exactly what it is. I am Nick, and today we are breaking down earnings per share. Earnings per share, or EPS for short, is a fundamental investing metric that measures how much profit a company generates for each unit of ownership, its share. Think of it as slicing the company's total profit into equal pieces, one for each share that exists. It is like slicing a pizza, the company's profit, into pieces for every shareholder, anyone who owns stock in the company. EPS is very powerful because it lets you compare a massive corporation like Metro Coffee to any smaller competitor like the Daily Brew on an equal per share basis. You'll see its value in the next example. So, how do we calculate it? The formula is very simple. EPS is equal to net income over number of outstanding shares. Net income or profit is the company's total profit after taxes and expenses. And the number of outstanding shares is simply how many shares exist in the market. So, EPS tells you how much of the company's profit belongs to each share. If you own one share, that's your slice of the pie. Let's make this visual with a simple example. Here are two coffee shop chains, Metro Coffee and the Daily Brew. Metro Coffee made $100 million in profit last year. The Daily Brew made only $10 million. At first glance, Metro Coffee looks way more profitable. You might think it is a better investment. But here is the catch. We also need to look at how many shares each company has. Metro Coffee has 100 million shares outstanding, while the Daily Brew has just 5 million. Now let's calculate their earnings per share, or EPS. Metro Coffee, $100 million profit over 100 million shares is equal to $1 per share. The Daily Brew, $10 million in profit over 5 million shares is equal to $2 per share. So even though the Daily Brew made 10 times less total profit, each share actually earns twice as much. But how much does each share cost? Metro Coffee's stock trades at $20 per share. The Daily Brew trades at $30 per share. If you invest $1,000, you could buy 50 shares of Metro Coffee or 33 shares of the Daily Brew. Which one should you buy? Each Metro Coffee share earns you $1 per year, so your 50 shares represent $50 of earnings. Each Daily Brew share earns $2 per year, so your 33 shares represent about $66 of earnings. So for the same $1,000 investment, the Daily Brew gives you exposure to more earnings, even though it is a smaller company. But here is something very important to remember. These earnings aren't the same thing as dividends. EPS tells us how much profit the company earned per share, not how much it pays out to shareholders. A company can decide to reinvest those profits, pay down debt, or save for future growth instead of distributing them as dividends. So, even if a company's EPS is $2, that doesn't mean you will actually receive $2 in cash per share. You might get only 60 cents or sometimes even $0, depending on how much the company decides to pay out as dividends. EPS just shows how profitable the business is on a per share basis. If you want to learn more about how dividends actually work and how they differ from EPS, check out my dedicated video on dividends. Click on the card here. This example shows why EPS matters. It helps you compare companies of completely different sizes on equal terms. But keep in mind, EPS alone doesn't tell you whether the stock is cheap or expensive. For that, we would also need to look at valuation metrics like the PE ratio. Still, EPS is where every great analysis begins. Let's make this knowledge stick by looking at a real company, the Coca-Cola company in 2024. To gather these numbers, I am using QuickFS, a great tool for investors. You just search for the company you are interested in using the ticker symbol, KO for example. You select the income statement and you can see up to 10 years of financial data. For this example, I have actually hidden the EPS column so we can calculate it ourselves step by step, just like a real investor would. The Coca-Cola company in 2024 had $10.6 billion in net income and 4.3 billion basic shares outstanding, so that $4.6 billion will be shared among 4.3 billion shares. I'll explain what diluted shares mean in a moment. Calculating EPS is simple. Basic EPS is equal to 10,631 million over 4,309 million equals $2.47 per share. This means each share of Coca-Cola earned about $2.47 last year. But remember, this isn't the same as dividends. In 2024, Coca-Cola actually paid $1.94 per share in dividends. So even though the company earned $2.47 per share, shareholders only received $1.94 in cash. That's about 79% of the earnings paid out as dividends. The remaining 21% was kept by the company to reinvest in the business, pay down debt, or buy back shares. EPS shows how profitable the business is per share, but it doesn't automatically translate to all that cash going into your pocket. After calculating basic EPS, we can also look at diluted EPS. Think of it like this. Imagine the company might give out a few extra shares in the future to employees through stock options or to other investors through convertible securities. If that happens, the total number of shares goes up a little, so each share's piece of the profit gets slightly smaller. Diluted EPS shows this what-if scenario, giving a more conservative view of earnings per share. Diluted shares for Coca-Cola are slightly higher, at 4,320 million, because they include these potential shares. Diluted EPS is equal to 10,631 million over 4,320 million equals $2.46 per share. As you can see, diluted EPS is slightly lower than basic EPS. This difference is usually small, but it gives investors a more cautious picture of profitability, accounting for potential dilution from stock options and other securities. Now, here's something important. You should only compare EPS between companies in the same industry. Let me show you why this matters by comparing Coca-Cola to its biggest competitor, PepsiCo. Let's pull up PepsiCo's 2024 numbers. It had $9.5 billion in net income and 1.3 billion basic shares outstanding. So PepsiCo's EPS is $6.97. Wait, PepsiCo's EPS is $6.97 compared to Coca-Cola's $2.47? Does that mean PepsiCo is 3 times more profitable per share? Well, yes, it does mean that. Each share of PepsiCo represents more earnings than each share of Coca-Cola. But here is the million-dollar question. Which one should you actually invest in? This is where EPS alone stops being useful. Because here is what EPS doesn't tell you, the price. If Coca-Cola trades at $60 per share with $2.47 in earnings and PepsiCo trades at $160 per share with $6.97 in earnings, which is the better deal? Which gives you more bang for your buck? To answer that question, you need the PE ratio, the price to earnings ratio. And that's exactly what we are covering in the next video. I am going to take these same 2 companies, Coca-Cola and PepsiCo, and show you how to use the PE ratio to figure out which one is actually the better investment. So click on the card here to watch that video next. Trust me, you don't want to make investment decisions based on EPS alone. The PE ratio is where it all comes together.